name's Grant Swartzwelder, president of OTA Environmental Solutions, and welcome. This is the 40th version of the Oilfield Strong webinar that we started and worked with the PBPA for quite some time. We started it a couple of years ago and was weekly during the COVID time, and now we're doing it monthly. But it's nice that we've been able to continue to do this and that y'all maintained interest in that. With everything else, we will have this recorded and posted on our YouTube channel. You go on YouTube and look up OTA compression, and you'll see Garrett's presentation and any of the previous presentations that you might want to see. Our next presentation will be August 3rd, again, every first Wednesday of the month. And that will be Richard Brantley, who is second in charge of university lands. I'd like to say that it seems like he's the largest landlord of the oil field with all the university land acreage out there. And so interesting perspective on ESG, on the oil industry that he'll be able to provide, and that'll be in August. But I am delighted to introduce Garrett Golding, who is a senior business economist at the Federal Reserve of Dallas. The neat thing about his background is that he has experience with the U.S. House doing work there. He's been with a consulting firm, and then prior to the Fed was with Pioneer Natural Resources doing a strategy for them. So he's, I think, is able to bring a lot of different perspective, and it helps that he actually has been with an oil company. So that makes people like me excited, because then he kind of knows kind of the fun that we have and the perspective that we might have, and he can include that in his presentation. So the only negative that I saw of his bio is that he did go to Baylor, and so as a good Aggie, that caused me pause. But then he went and got his master's from the U.S. Naval War College, and since that had Navy and war, that made A&M kind of made me a little more excited and happy. So so it all worked out, Garrett. We're all on good terms here. So. Well, one thing I'll also mention to everyone, and Garrett will allude to this, is that he has written several good articles, some of which we'll talk about through here. I get them from the LinkedIn, but he'll tell us where to get on the Federal Reserve. It's talking about oil prices and the effects that the market might have on those. Also about higher fuel prices and what effect that could have on drilling and again, oil supply and demand. Very fascinating. You see a lot of questions out there in the marketplace, like from our president saying, why can't the oil companies increase production and lower pricing? Well, that article addresses that. But for some of y'all that don't want to read, we have Garrett. So Garrett, let me start off with that question of, why aren't these stupid oil companies doing things to reduce gas prices? Why are we the bad guys? And
Sure.
I'm being sarcastic.
Right. So, to go back to these papers, we, Dallas Fed and every reserve bank maintain a blog on our website. So if you go to dallasfed.org/economics, it'll take you right to the homepage for that blog, and it's usually 1 to 2 a week, either a blog post covering, I'd say a good portion of it is energy topics. There's more energy economists than just myself that are in the research department, and we're always putting something out, either on oil and gas, global markets, on electricity and renewables, try to cover as many bases as we can. And the reason for that is we are the only Federal Reserve Bank with a dedicated energy team. There's 5 of us here. Each regional bank has a focus within the research department on whatever is most important to that district. And so since that we're all of the state of Texas, southern New Mexico, and northern Louisiana, we are playing point man on energy for the entire Federal Reserve System. So yeah, go to the blog. You can also see the Dallas Fed Energy Survey, which just came out last week, and it is published every quarter. Pretty closely monitored barometer for what's going on in the shale patch. So to get back to your question on why aren't oil companies doing something? The first thing that we always point out is oil companies do not set oil prices or gasoline prices or diesel prices. This is a free market of commodities that are traded by thousands of market participants every minute of the day. And in so much as the oil industry has an impact on this, the response among most of the public is, well, why don't they just produce more oil? And there's a few reasons for that. As I'm sure everybody who's tuned in here has been made well aware over the last few years, there's been a pretty fundamental shift in how the oil and gas industry operates over the last 5 years. Throughout the 2010s, or through most of the 2010s, just growth at all costs, production growth at all costs. And that's where the incentive structure was laid out for these companies. That's how the food chain of private equity backed groups function, was to prove up your acreage, get bought. And then that larger company was going to go on and produce 20% year over year supply increases, because that's what Wall Street wanted. Of course, that all kind of fell apart in 2014-15, when we finally caught up to where the rest of the oil market was. And that's when OPEC slapped down on U.S. shale and ramped up production, flooded the market. Prices crashed from over $100 to the 30s in a matter of a couple of months. Instead of stunning growth across the shale patch, it just made the industry much more efficient. Of course, there was a lot of layoffs. There was a ton of equipment that was scrapped, and the industry found a way to produce a lot more quickly with a lot fewer people and a lot less equipment. And so that was what was happening throughout 2016, 17, 18, where this eventually evolved to Wall Street saying, okay, you don't have to grow as fast as you were in the past. You were never making money profitably anyway. We demand returns. We demand dividends. And you're not going to be able to do that if you collapse the oil market again by this runaway production growth that you've had in the first part of the decade. So companies took much less aggressive production plans. We're not, spending every dollar of free cash flow back into the ground. And so we kind of leveled off at this slower production growth path over the last few years. And then COVID happened. Another complete collapse in oil prices. I don't think in this industry many people, have seen two near-death experiences like that close together, just within a matter of 5 years. And then again, more layoffs, more bankruptcies. And then Wall Street, came back and said, say we're serious. You guys need to be sustainable in your finances, and maybe only grow at single digits. And so that's where that's the situation we ran into coming into the post-COVID world of demand globally starting to outstrip supply. And this was not just something that was happening in the U.S. And how the business model here changed for the shale industry, but OPEC plus, national oil companies. Those couple of years of underinvestment really stunted their production capacity, and for the last year, they've been unable to meet their production quotas monthly, really ever, since they've been trying to re-enter, get production back up over the last year and a half or so. So that's the situation we found ourselves in going into the Russia-Ukraine war, where there was all-out panic into February, March in the oil market that 3-4 million barrels of Russian crude would come offline due to sanctions. That hasn't really played out as was anticipated. And so we're starting to see a little bit of a retrenchment from that over the last few weeks. Not just that these sanctions aren't going to be quite as biting as quickly as we were anticipating, but also because prices surged so high, we're threatening recessionary levels of prices. And I'm sure we'll talk about that later on. So when it comes to companies, coming out and producing more at lower prices, there's two things that won't happen. One, they're already growing. We anticipate the U.S. is going to grow somewhere on the order of 700,000 barrels a day between the end of last year and the end of this one, which is the most growth that we're going to see from any country over the course of those 12 months. The question is, how much more can they do? And they're extremely limited on that. And it's not just a shareholder, profit-seeking type situation. It's the fact that we just hear and have heard for a year now, we can't hire enough people. We do not, the equipment is back ordered 6, 12, 18 months, depending on what you're looking at. There is just not enough productive capacity to ramp up production beyond current plans. So, and we're not going to know what 2023 looks like for many of these companies until the end of the year. But it seems that this new paradigm of single-digit production growth among the public companies is really here to stay, and it's not just a function of shareholder demands and generating more profits. It's a function of exactly how many rigs can get out there and how many people are qualified to actually run on them. So, very long-winded answer, which is why it doesn't really show up in the news every day or in a political soundbite.
Well, as we're dealing with kind of these myths or these storylines that seem to be thrown out there, another one that kind of speaks to increases, there's, 9,000 federal leases that exist out there. Why aren't they drilling them? They're only drilling a fraction of those. And so, and I know one of your articles addresses that, but I think to talk about that, that's something, that soundbite sounds awful for the industry, that they're just not drilling. But right. Could you address that and kind of what the rest of the story is on that?
Right. So, and that is, I believe in one of the articles we published a couple months ago, 9,000 permits are not 9,000 profitable well locations. If we look out over the last 4 or 5 years, the amount of permits that are issued and the amount of wells that are drilled using them is around 50%, the ratio. Companies will acquire permits to have the optionality on the acreage that they've leased and not really, fully know what exactly it is that they own at that moment. But it's important for them to have that permit because it lasts a good 2 years, and to keep extending them if they think that it's something, an area that they want to get into. So right off the bat, you can assume that, less than 5,000 of those permits are going to be used. The other piece of this is, between 2,000 and 3,000 wells are drilled on federal onshore every year anyway. So, to talk about, let's call it 5, to be very generous and say there's 5,000 permits that are ready to be drilled, it's going to take a few years to get through that. On top of all of the, logistical and labor issues that we're talking about here. So it's, in a lot of ways, the whole 9,000 drilling permit thing is borderline irrelevant because they're working through the inventory of permits that they have and doing them really as fast as they can. And I think that over the last 2 years, we've seen a ramp up in activity, despite what you would see, some of the narrative on this. A ramp up in permits issued and ramp up in drilling on federal land because of the uncertainty that lays ahead, 2, 4, 6 years down the line here, where a lot of operators are not exactly sure what kind of regulatory environment they're looking at with the leasehold that they have. So they're trying to churn through federal permits as quickly as they can, which runs kind of counter to this perception that they're not doing enough with federal acreage at the moment.
Well, and that point, and I see one of the panelists or attendees, Carol Leach, who's probably knows this better than I do by a long way, but you look at like New Mexico and some of these areas that have a very strong regulatory environment. I don't know if you've looked at, was there a big flood of permits and kind of let's at least get it while we can because of the fear of the regulatory world shutting down on them, or was that not really a driver?
So there was a lot of permits applied for it and issued in 2018, in 2020, with the anticipation that there would be a new administration and new rules. and so there was just, that fed into this 9,000, permit, backlog or whatever you want to call it. There's a lot of outstanding permits out there that were built up over that year. And then in 2021, with the leasing and permit pause that occurred in the first half of the year, a lot of contacts we spoke with at that period, they were telling us we're trying to drill as many wells as we can with the federal permits that we have. Others were telling us, we're leaving New Mexico as kind of I won't say what kind of hand signal to the state or the federal government or whatnot, but they were kind of in protest that we're out of here. But it seemed, among our industry discussions and those contacts, that it was more the former, that there was an acceleration in trying to get as much federal acreage drilled as they could while they could, just not knowing what would be happening, what would happen next.
Especially because so many, you look at Eddy and Lee County, which is such a prime Delaware acreage, that a lot of people spend a lot of money for that. And if they can't drill it, then that's a lot of money goes away. One of the comments you also made, I wanted to go back to talking about kind of Saudi and the volumes. It used to be Saudi was a swing volume, and then you hear, well, they really can't increase. And President Macron, I guess, helped publicize that a week or two back with his little whisper to Biden. But have y'all looked at any of that? And that might be more macro than where y'all go, or maybe it's exactly, but kind of, is there any swing producer out there that can really step in, or is that the
it is something we look at pretty closely because we develop a global balance for every Fed meeting, and we have to take into account what Saudi does and what Saudi says they can do. So they're producing a little over 10.5 million a day right now. In April 2020, when they crashed the whole thing, they ramped up to 12 million a day for the first time. We understand that there were some crude quality issues when they ramped up to that level with their customers. So at that period, 2 years ago, 12 being the max, it was kind of 12 million a day, with an asterisk on it. Since then, their rig count has come down considerably. It's pretty unlikely that they could hit 12 again, in our view. So the thing is, there's a lot of room there between 10.5 and 12 right now. When President Macron said that they only have 150,000 a day left, I think he didn't really understand what he heard. And
what, a politician not understanding?
Right. And I think what was actually communicated to him was, and obviously I wasn't sitting there, in the discussion, but that falls more along the line of what they're capped out at on OPEC production quotas right now. It's extremely unlikely that if they're producing 10.5, that their max capacity is less than 10.7 right now. I think we could put bumpers around 11 to 11.5, which is still not exactly a very big cushion for the global oil market. So it's a bit of a catch-22 for the Saudis going in here these next few months if demand does strengthen, which is a kind of a whole other conversation. If they do whittle into that spare capacity, which if it's in that 11, 11.5, or to be generous, above 11.5, it's the more that spare capacity is whittled down, the less shock absorber there is for global oil demand. That starts to get oil traders very nervous. And so even though there would be more oil put on the market, when there's less spare capacity, that's when you start to see, more volatility, higher prices as a result. So they're really, trying to play it cool at the moment and not, ramp up production and, potentially expose other issues on spare capacity, and also send jitters throughout the oil market. So, it's also their perspective is this isn't entirely an oil supply problem that we're dealing with right now. This does come back more to global refinery capacity. That's where a bigger bottleneck is occurring here and in China and in other markets that had been importing a lot of Russian refined product. So, just throwing a bunch of medium and light Saudi crude into the market where there's a product problem and a heavy Russian crude mismatch isn't necessarily going to help anyone from their perspective.
So Saudi, it seems like has always been that swing, but then you hear about how Iran, if they are able, there's some volume. Who knows about Russia? And then it seems to always go back, or now it goes back to US that we, and therefore while we were the swing producer, it seems like, and we could still be. So looking at those other options, how does this play out?
So on the Iranian piece, I mean, there's 1 million barrels a day, pretty quickly that could come on if there is a big nuclear agreement here. We've been talking about this for a year and a half now, like it could be something that is just a month away. And it seems as soon as they get close to the goal line here, something else pops up. So we're not exactly holding our breath that another 1 million a day out of Iran pops up over the summer, but it exists. And if they're on, the other piece of this, American spare capacity, again, it just goes back to what we led off with. We haven't done very finely tuned modeling on what 2023 looks like, but I think that we can still anticipate somewhere of a repeat from where we've been or where we're heading this year, on the 700, maybe 1 million of production growth next year out of the US. But this is still a mismatch with where demand could be heading. Again, absent some kind of broader macroeconomic slowdown in the near term. If you look at the IEA's projections for next year, in a lot of demand forecast, surpassing pre-COVID levels, by the beginning of next year, without adequate supply response, absent something like Iran coming back. And you're looking at still persistent inventory draws globally as a result of that. So, we need more capacity from somewhere, and we need it, pretty soon.
But the thing that confuses me, you talked about basically demand increasing, I think is what I just heard. But then I also hear the R word, the recession word, which if I remember my economics class, that should hurt them.
Right.
So, all right, we're talking out of both sides of our mouths on increase of demand and decrease of demand. Help me out with that.
Yeah. So, and this is something we've done a bit of work on lately. The demand in the U.S. at least is going sideways right now, where it should be going up under normal circumstances. We started the year, within really on track to meet pre-COVID gasoline and diesel demand, and then eventually surpass it. Ideally, probably around now, in the middle of summer driving season. But around the first week of March, we started to depart farther and farther away from that trend line. So, Russia invasion Ukraine, February 24th, prices immediately, rung up, Brent $120, $130 throughout that first part of March. And, obviously gasoline, diesel is skyrocketed right after that too. So, we are seeing this demand destruction element happen to some degree. It's not, I think people would associate that phrase with a big drop off in demand, and it's more of an erosion at the moment, where it's demand that is foregone. We should be higher than where we are today, and we think that is due to higher prices and changes in consumer behavior and things like work from home. Look, where I am today. I mean,
right.
People, may have been going to the office 3 or 4 days a week at the beginning of all this and said, you know what, I can probably only go once a week now, just to save money on fuel. That wasn't an option, 3 years ago. And there's just, people canceling vacations and whatnot. I mean, you see plenty of stories about, high travel demand and crowded airports and that kind of thing. But there's considerable coverage right now about through AAA and the surveys that they do on people canceling driving and vacation plans over this summer. Of course, the world's a lot different now than it was just 2 weeks ago on pump prices. So we'll see if that changes much going forward. But yeah, we are seeing a bit of a demand coming in slower than what most were anticipating at this time when we were sitting here at the beginning of the year. A true recession and a major slowdown, which seems to be what the oil market is starting to price in at the moment, it's difficult for us to see the kind of price action that we're seeing in the last few days is fully justified in the data at the moment. I mean, the demand levels are not, they're not strong. They're not exactly collapsing either. So, this is also, it's still looking like a pretty tight supply and demand balance for the rest of the year. And we're seeing this in the futures curve where, there is quite a big premium on that, first through the third month futures contracts, which is telling us that the physical market is still screaming for barrels for delivery right now, which isn't something that happens when demand starts to implode.
We try to keep this around 30, 40 minutes. And given that time, what I'd like to do is now take all this macro and bring it down to kind of Texas and New Mexico and let you look at that magic ball and say, how does this affect the Permian Basin or Eagle Ford? And it sounds like partly there will continue to be drilling, there will be continued expansion, supply chain, but what do you think our listeners can kind of look forward to or expect over the next rest of this year, next year, based on all these macro issues we just discussed?
Yeah, I mean, I think it would take a really, widespread negative macro event for us to see prices, dip down below $80 or something and start to potentially change the pace of drilling activity right now. I think a lot of these companies, I mean, all the communication over the last year really has been to be on cruise control, and really not in anticipation, but to be prepared for a scenario like this where we don't ramp up and get out over our skis on CapEx when prices go high, so that we're protected if and when prices do drop. So you may see a little bit of more flexibility out of the private operators that have that don't have the same kind of constraints on them, and have been responsible for a lot more of the activity over the last year and a half or so. But I'd say and with prices staying at a relatively healthy level for the industry, 80 or above, you're going to see still activity increase over the next year or so. It would take something pretty catastrophic for that to change. On the flip side of that, it's really hard for us to see where we're going to have an acceleration beyond what's already planned. Again, because of logistical issues, and I think that there's still an argument on if a lot of those are even doable because of the labor issues we keep hearing about. It started with truck driver shortages, which is just rampant across the whole economy, really. And now we're hearing stories of rigs where the average tenure of the workers on it is 6 months. So that doesn't spell a very safe environment, in my mind. But you hear things like that going on. That really raise questions of exactly how much faster can activity, or if activity can accelerate at all beyond the amount of rigs that we add on every month right now.
So you talk labor shortage, you talk supply chain, and then clearly I would think the capital markets is still putting a thumb on the industry to some degree. So you got three things there, and and you don't really see any of those changing anytime soon, or I don't. There's not going to be 1,000 employees all of a sudden moved to Midland, and
Right.
supply chain, it just seems to keep on muddling through, and capital
Mhm.
market seems very happy with doing as so. Does any of that change in the near term? And near term, it seems
It-
like is not just next 6 months, but next year, year and a half, 2 years.
Yeah, I mean, on the capital markets piece, it's obviously something we spend some time on because of, bank oversight, regulation, and whatnot. And I'm not one of those people, but it's in the system. Um, and that was definitely a loud, chorus we heard from a lot of different contacts. Coming into COVID was, banks and other major institutions backing out of fossil fuels entirely. And that was definitely a very strong trend for the last few years. I see a little bit of a shift in that happening right now. And it's not just because of the fact that energy has outperformed the S&P, to a devastating extent over the last, since the beginning of the year. Although
I bet that helps a little bit. That you look
yeah,
at what most of these
you
sectors
would
are, and they're like zero or negative, and oil is in double digits plus.
right, right. But I think that you see some major institutions that are changing their tune a little bit on this. That that this transition isn't exactly functioning as smoothly as we were all hoping it would be. And that's what we've seen over the last few months. And that doesn't really seem to be, there doesn't really seem to be any improvement on the horizon for that, unless you have more natural gas. I mean, like what we're seeing with natural gas prices, and kind of the growing integration between Henry Hub and a lot of foreign gas markets, which didn't really exist until just recently. You can see, we've heard from some of, and these are out there publicly, some major voices out there among that world that we need to rethink going and helping finance responsibly produced hydrocarbons from countries like ours that are have the right environmental regulations in place, are not Russia, and able to produce and send particularly natural gas to foreign markets that are trying to get off of Russian gas. So it kind of puts an emphasis on the G part of ESG, that this could be a positive for the U.S. oil and gas industry going forward among some of the market participants out there. I mean, we're starting to see a little bit of that discussion develop. We'll see where it goes.
Yeah, and not to turn this too political, but I've heard that many times, that point that, if the US is actually producing within the best ESG metrics, they should want us to produce more here and try to shut down China and Russia and all these that have, you see terrible metrics on. But that's a tough one to solve right there.
Yeah, absolutely. And again, the capital constraint piece of this, we were hearing from a lot of mainly in the private operators, midstream places that are a little bit more exposed to needing bank financing. That's where the issue, the hang up has been for the last few years. But if you look at the public debt being issued over the last year or so, it's been a pretty solid environment for that. There is a lot of investor appetite, and it's not just retail investors that are coming out after this. So it's still there, access to capital, and where it has been pinched off in some quarters. We'll see if these dynamics that you just laid out, how much of an impact that starts to have here over the next year or so.
Yeah, because if you can't get your money through commercial banks, you definitely can't get it through public equity. Mm-hmm. And then you kind of wonder, and you saw it with Continental wanting to go private. It's like, do you even need to be a public company in the oil industry now? It's what are the benefits of that? So kind of changes the whole capital structure and growth structure that that oil company would look at.
Yeah, definitely. Yeah.
Well, good. Well, Garrett, we try to keep it 30 minutes. Very interesting. So we drug it over a little bit. Thank you very much for your time and great insight. Again, everyone, really urge you to pull up their blog, some good articles. That there's an interesting part that we didn't get to, talking about diesel and kind of the issues associated with pricing on that, which affects a lot of the oil industry, obviously. So I found that very interesting, and we just didn't fit it in. And then look forward to seeing everyone August 3rd with Richard Brantley on University Lands. Garrett, thank you very much.
Thank you.